Hey everybody, Joe Joseph here for thedailysheeple.com, and this is your news shot. Let's go to the Washington Post. They say the richest 1% now owns more of the country's wealth than at any time in the past 50 years. Looks like all that work, the anti-monopoly, the antitrust movement, the push against the money trust at the turn of the 20th century, all's been undone and then some. I highlighted yesterday how even these emerging forms of wealth, cryptocurrencies, are being hijacked by those with means, if you will. 4% of Bitcoin owners own 95% of all Bitcoins. The top 1% own 40% of all Bitcoins. So, very interesting there. It says here the wealthiest 1% of American households now own 40% of the country's wealth, according to a new paper by economist Edward Wolf. That's a share that's higher than at any time since 1962, according to Wolf's data. From 2013, the shares of wealth owned by the 1% shot up by nearly 3 percentage points. I mean, you're talking about over time, it's kind of slowly dipped and rose and dipped and rose, but it stayed fairly constant. And then, about 3 years ago, it just started to shoot up. Now, today, the top 1% of households own more wealth than the entire 90% of the bottom 90% combined. Now, that gap between the ultra-wealthy and everyone else has become wider and wider and wider over the past several decades. So, wealth, of course, is often described as net worth, according to the Washington Post. And this basically describes how much stuff you actually have. It's the value of your assets minus the value of your debts. So if you have a $250,000 house, but you still owe $200,000 in the bank, to the bank, but you have no other debts, that means your net worth is about $50,000. In the United States, the distribution of wealth is even more skewed towards the top than the distribution of income. But let's say that America is a country of 100 people, and all the wealth in the country, the homes and land and financial assets, is represented by 100 slices of pie. That works out to an average of 1 slice of pie per person, which is exactly what everyone would get if we lived in a society where wealth was equally distributed. But that's not the society we live in, and indeed, that's not society that most of us want to live in either. Because people generally agree that if you work harder, you're entitled to more pie. And that if you don't work at all, well, barring certain circumstances, no pie. So, what happens? Michael Norton and Dan Early in 2010 surveyed more than 5,500 people to find out how they thought wealth should be distributed in the country. How much pie should go to the top 20% of Americans and the next 20%, and so on all the way down. Now, on average, respondents said that in an ideal world, the top 20% of Americans would get nearly 1/3 of the pie. The second and middle quintiles would get about 20% each, and the bottom two would get 13 and 11 slices respectively. A little more evenly distributed. But the problem that you have there is it never ends up working that way. You see, there's an old adage that says you got to have money to make money. And oftentimes, you'll find that true. When you're trying to start a business, you can't start it from nothing. Very seldomly, if ever, are people successful starting from nothing. Oftentimes, great ideas have financial backers. Again, Peter Thiel's a great example of a venture capitalist that, does just that. And there are many of them out there. But typically, you don't take an idea and get it out there and make it mainstream unless you have some sort of financial backing to it. And it's during these booms and busts that the wealthy make the most money, because typically they're the ones that cause the bust. And then when the bust happens and everything sinks to a low, well, they buy cheap. They sell high, they buy low. Sell high, they buy low. Each time, they're just taking out basically huge transfers of wealth are taking place. And this wealth gap just gets wider and wider. So as much as you try to poll people as far as how they think wealth should be redistributed, it never, ever ends up being a permanent thing because any changes you make over time are done away with in any sort of construct of government. Here in the United States, you had reforms at the turn of the 20th century that took some time to get rid of after they busted up the big companies. But over time they did. You know, as companies got larger and larger again, their lobbying presence got more strong in Washington. Reform to the election laws and the way that you can fund Congress took place. And then the landmark 2010 Citizen United decision that said corporations are people and people are corporations, and you can't limit a corporation's First Amendment right to freedom of speech. Therefore, you can't restrict their ability to donate to their desired candidate, because limiting that would be limiting their freedom of speech. It was a basically nail in the coffin to the U.S. election system. Now, you might get a outlier here and there that can get in. You know, was Donald Trump an outlier? Remains to be seen. However, sometimes you do. You see lightning, catch lightning in a bottle, and it can happen. But I would say more often than not, you have people that are put in there by corporate money, corporate dollars. These are your establishment figures that are basically puppets of the establishment and the control freaks. And it's done that by, it's all done by design. So as much as you try to reform the system, it only works for, but a short time before you're back again full circle. Here we go. So here we are again at the precipice of a huge chasm between the haves and the have-nots. And then Bitcoin comes along. And Bitcoin starts out and value is low and it's bumpy. But over time, over the long run, it's been a fairly good investment. Now it's shooting up like a rocket. And then you start to look at who owns it. And it's interesting because, again, top 4% of all Bitcoin owners own 95% of all Bitcoins. Same thing, same dynamic is taking place in what was supposed to be, this big free market type of thing. Just like in the 1920s during the Great Depression, you had these heavy hitters on Wall Street that were just flooding the system with easy credit, easy credit, easy credit until the credit dried up. And by that time, everybody had taken out loans, baggers at the grocery store, everybody had stock, right? They like to talk about it. It was a badge of honor until a crash happened and everybody lost their shirts. But the bankers knew it was coming because they sold high. See, they just waited for that time and then they pulled the rug out from underneath the market, bubble burst, people lose their shirts, and then they go and they buy low. They go ahead and they basically go to the flea market of depression. And they get a bunch of valuable stuff cheap. And this is what they do, taking advantage of the boom-bust cycle that they control. And now you have Bitcoin approaching $20,000 a Bitcoin at breakneck speed. And you look back at history, at all of these boom-bust events, and it's very hard not to see Bitcoin as another one of those bubbles just waiting to burst. And for the rich to swoop in and pick up the pieces. We'll see what happens as it goes on. I'm Joe Joseph. This was thedailysheeple.com's News Shot. Feel free to comment below and visit our website at thedailysheeple.com. #WakeTheFlockUp. Have a great day, everybody.